Hello, good evening, and a very warm welcome to the next session of Powerhouse Series BFSI. Today, we will be continuing with our previous topic, that is evaluating investment and financing decisions. We have with us our esteemed trainer, Mr. Muslim Raza, and he will be covering the topic on the portion that was left in the previous session. Now, we'll be covering the areas of the topic that were left. So without losing much time, I'll hand it over to Mr. Muslim Raza so he can kick off the session for me.
Thank you, Feroz. Assalamu alaikum, everyone. Last session that we were having a discussion on, we talked about looking at various investment decisions. We looked at the various asset classes, and then went through our mind map on finding the intrinsic value of an organization, of an investment, of a project, and then trying to see how investors and how speculators view an investment, and then how they look at what is the best way to find the right value of an investment. We looked at how the difference between investors and speculators in their mindset, and the fact that whatever the investment mindset, the key thing is that the intrinsic value of an organization, of an investment, of a project, in the long haul acts like a magnetic force, to which the price of the underlying asset being discussed flows through and reaches that item. We went through the thought process of the fact that the prices may be undervalued or overvalued for some time, and that may cause the stock or the investment to overshoot or undershoot than the perceived intrinsic value. And the thought process that that we should be entering into an investment decision when the security is undervalued, and we should try and exit from our long position and maybe enter a short position in a situation where the stock or the investment is overvalued, and because in a symmetrical move, the price will fall down and towards its intrinsic value. The premise for all of that was that we have an efficient market, and then we looked at the information metrics, and we evaluated the fact that that an efficient market where all public material information is priced in, and then the thought that comes in is, why would in an efficient market would there be opportunities to make money, and in a situation where securities would be under or overvalued? The case in point, or the thought process behind that, was that the securities would be undervalued or overvalued because all of us have a different perspective to look at things, and therefore the Jory window by which we look at the outside world and we look at the underlying assumptions for our security. The case would make for either buying or selling the security, and that causes difference in opinion, and therefore people would buy and sell the investment. The key thing that we need to understand is that the ethos that we all have to strive by is that we do not use or leverage on any private material information available in the market. Which if somebody tries to leverage on any private and material information, it would give an opportunity for insider trading or arbitrage in the market. The judgment calls for the cash flow, the magnitude of the cash flow, the timing of the flows, and the riskiness of the company causes people to have difference of opinion. The fixed income market is typically an art of eliminating the bad outcome, and then we are left with something that is one of the best things to live with. Whereas equity as an asset class and the investment thought process behind equities is that it is an art of finding the best outcome, and therefore that's typically slightly more difficult for one to go through that process, and requires a more detailed thought process on both the terminal value, the cash flows under the project, and there are a lot of economic judgments on the business environment, the growth rates of the company, the consistency, and one of the key things that we need to understand and look at are the various discount rates by which we look at the future cash flows and bring them to current value, which is the weighted average cost of capital. One of the key things that drives any valuation is information, and looking at that information and pricing that information correctly, and making the right set of judgments. Post that, then this was a section one, or part one of our presentation. Post that, we moved into our second leg of our transaction, and we looked at the financing routes. So today, just recapping on what we will be doing today, we will look at the financing routes available, and then we look at one of the key thought process of the upcoming science of behavioral finance, and try and understand how behaviors drive investment or financing decisions, or decisions as an overall financial tool. Post that, we will at the fag end of the session, we will be joined by one of our market participants, the CEO for Chase Securities. He will join in and run us through how the market stands right now, and then you can shoot the difficult questions on valuations to him. Just a run through on the Q&A session. So we'll have Q&A sessions in two parts, as I tend to wrap up my session around 7:15. We can have the Q&A sessions for the financing route. During the session, from now till then, please feel free to drop in your questions, and as time comes in, Feroz would help us to pick in those questions. And similarly, when Ali is done with his presentation, he will be happy, and I will be happy to field any questions that you have on his area. So starting with the financing route, the last time that we talked about financing routes, we did look at the internal funding for an organization via working capital. We looked at liquidity management, borrowing, account receivable, account payable, and inventory management as ways and means to raise cash flow for an organization. With the current trending situation, and how shipments and routes have been affected due to COVID, and how ports have been jammed due to container blockages and ships unavailability, and staff unavailability. We did talk about the fact that EOQ and JIT have now become a little obsolete, and organizations are maybe looking at ways and means to now manage inventory and orders based on how the world would develop based on COVID, post-COVID scenario, which is the new normal. One more thing that I'd like to pinpoint here is that we have seen a round of interest rate increases all across in the last week, and there have been a call of recession, and how prices have moved, with that, one thing that we need to be careful on is that there is a chances of reflation, which is a recession with inflation coming on in the world economy. How that impacts our working capital is that potentially we will have a long drawn cash cycle with that, as inventories would again tend to pile up. People would delay their account payables, and receivables would tend to pile up as people tend to buy things on credit. So that's another pressure on the organization in the current scenario, and that is something working capital becomes more and more important, and similarly availability of lines and limits for an organization which it can draw upon for short-term borrowings, and it becomes a more important element to do. Similarly, mismatching and lending as an activity becomes more dangerous because as cash flows, while matching would come in as a logical answer in this situation where you will match your receivables and payables with each other. But the key thing that we need to understand is that even in this situation, the clarity and the coherence on the cash flow dates coming through becomes more judgmental, and with as we see the floods in Pakistan. So if you look at the rice business in Pakistan, the inventories, the raw material has been delayed, which means that any shipment that could have been done in the finished goods market has also been delayed, which means that the account receivable have delayed. And so if supposedly if a rice exporter was managing his or her inflow and outflow, and then was not looking at any short-term borrowing, there is potential that he would have to pay for buying the rice, because the hari the person in the field may not have enough money available to do his to fund his day-to-day life, and therefore may need help with respect to money on his daily. So his payables would come in early, but due to delayed shipments, delayed raw material, the receivables would get delayed, and any matching activity that he had originally undertaken would become would be delayed. So that's something that we need to look at as things develop and as the situation globally changes. Moving on from internal funding, we stepped into and we looked at how the short-term working capital lines become more and more important for an organization in this situation, and then with the changing interest rate situation that we talked about, and an upcoming recession, and with high inflation coming through, it becomes more important for one to get more clarity on the lines, and maybe have and then look at long-term loans, such that they can lock in liquidity. One thing that we need to be careful on, as we look at long-term loans and as we look at locking in liquidities, these are high interest rates, and in some countries these are life high rates. Even in Pakistan, we are very near to our peak interest rate situation, and peak rates that are there. So we need to be careful if we lock in life high rates and for our long-term loans, so the question that comes in is, should a customer be willing to, or should a organization be willing to lock in rates right now, and be ready to pay higher interest rate, and then their weighted average cost of capital would go up. as they lock in higher rates. Then when you look at long-term loans, the question that comes in is that what sort of long-term loans are you looking at? Are you looking at long-term loans taken by long-term loans taken from one entity, or we look at long-term loans taken by a multitude of borrowers and structured as a single paper? When you look at structuring them as a single paper, that's syndicated loans, and that's how that's when single borrower restrictions come in, and then you get multiple borrowers to fund the line. The benefit of it for the borrowers is that there are multiple people shedding in, so the risk of an organization gets distributed between various lenders. For a borrower, it becomes a little more difficult because getting in and explaining and agreeing to the covenants for all from everyone becomes a little difficult, and one needs to be a little careful around that. One thing that we need to keep in mind is that when you have syndicated loans, you have a lead borrower and an arranger. That lead arranger helps you get the buy-in from all other lenders, and then simply fronts everybody, and then makes your life simpler. Um, One of the key things that we need to look at is mezzanine finance. What mezzanine finance as a thought process is similar to what we in the startup world call angel investors, or loans from directors, or loan from such loans that are to be paid at the end, and maybe look at tier one or tier two capital also. So they can be termed as capital, and the benefit or the importance of mezzanine finance in this difficult world is more and more as the organizations may look at recapitalizing themselves, and find ways and means to fund their business from equity rather than debt, from ways and means where they do not have to pay regular interest rate, and then it will be easier for them to get breaks in cash outflows and inflows, and make their life easier. So moving on from there, we look at equity finance. We've done that. I think this is something most of us would have done in our education lifestyle. So I'll just quickly pass through them, and so common shares, preference shares, their public and private placements, and convertible, cumulative, non-cumulative, participating, voting, and statutory. If there are any specific queries that you have from there, we can address them in the Q&A session. But I think this is something that we've already covered in our both our course workload for ACC and CFA has quite a lot of stuff on that. Now the fashion that we see right now is venture capital or private equity, startups, and then how they operate. So let us walk through the life of a startup, and the financing needs, and how they are typically fulfilled. If you look at a timeline and we try to break that into various parts, a startup or a venture capital or a new fledgling company would actually be looking at financing in three parts. The first part being the early stage financing, the second part being expansion financing, and the third one when the company has made enough money, and the thought process is to look at and then the thought process is to actually try and spin the startup out and the founder or the organization becomes big enough for a professional management to step in. So if we look at the first stage of financing, the key thing that comes in with or how an organization starts up is via seed capital. Seed capital is typically put in by the thought process owner, the person who has the thought process and who wants to run a specific business. That individual, along with the idea, also comes up with a certain seed capital, and if he doesn't have that total amount of seed capital required to run that business, he takes that idea and goes to his friends and families, family, and close associates who would actually be willing to invest in him, and he takes that seed capital and puts that in, and using that seed capital, he starts up the business, where he prepares his feasibility. He does the basic groundwork and moves that into motion in terms of maybe hiring the first few employees, maybe setting up the product that may be needed to do, and starting it up. Uh, Guys, it's Adhan time, so if it's okay, we'll take a half a minute break till Adhan gets settled. Thank you so much. Apologies for keeping you on hold. Uh, All right. So what we were talking about early stage capital, early stage financing and seed capital, where angel investors come in and then fund the founder and the co-founder, and help putting the thought process into a shape, and into an outfit where it could actually be taken into on ground. That's when we move on to with startup financing, and startup startup financing is when the project starts to kick off. Typically, under startup financing, the borrowers, the key lenders for startup financing are again people who are well aware of the lender, of the founder, and therefore the lender is typically banking on the idea and the thought process and the personality of the founder, and he trusts the founder more than the idea in itself. Uh, Once the seed capital and startup financing stage has gone through, these could come in very quickly together. Then we move into first stage and second stage financing, which is also known as Series A financing. This is when we have seen some shape and form of the project. The project has moved into a phase where we see some sales coming through, where we see the idea in a more in a format which can be more identified, more plausible, more in a moving format. That's when Series A financing and venture capital in true form comes in. So these but even at this stage, we haven't seen much sales coming through. There isn't per se positive cash flow for an organization, and this is still a negative cash flow phase. So if you look at our and if you look at our early parts of our session, where we have been talking about cash flow as being the evaluator, what would be the key determinants of valuing an entity at this stage? When we look at valuing organizations in this phase, uh, the two key multiples that we so there are two key multiples that we can look at. One is actually looking at the multiple methods, where we look at how similar organizations in the market have been valued and how they have performed. Um, so that's one way to value an entity, value a fintech, a tech startup in the Series A round. The another way to look at are two key factors that are looked at by investors. The first one is the burn rate, and the second one is the client acquisition, or customer acquisition. When burn rate is typically the amount of seed capital and startup financing available with the investor or the founder, versus compared to that, the amount of cost that are there with an organization. As the costs are considerably higher, and versus the capital, the burn rate of the organization is substantially higher, and therefore it's valued lower. And in the other case, if for a similar organization, if the organization has a lower base, of lower cost base, it is valued more because the burn rate is lower. Or if the investor has a higher seed capital and startup financing available to burn, that's another cause of typically valuing it higher. Uh, the causes of burn would again be the cost that an organization has. The cost typically at startup age. Startup stage is, while on one end it is the staff and the employees that it may have. On the other side, one of the key cost determinants would be the marketing expense that organization in this early stage have to go through, because these fintech, these digitally charged organization typically require in this digital age, more and more marketing, more and more early first stage and digital marketing activities to be undertaken. The second criteria for evaluating organizations within the first stage and the second stage Series A financing is how is the acquisition rate, customer acquisition rate, and the customer profitability, and the cost per account. These three are all linked together, and let's look at them in one stage, one by one. When you look at customer acquisition, the rate at which the organization acquires a customer, how many customers are downloading the app, how many customers are registering, how many new customers are being onboarded by an organization per day, per week, per month. That's how you look at the customer acquisition. When you look at cost per account, it typically looks at for acquiring each new customer, the amount of money that the organization has to spend in terms of its salaries, in terms of its marketing expense, both variable and fixed. So if you remember our basic accounting, we've talked about variable cost and fixed cost. And this cost per account actually tries to break that and apply that concept of variable and fixed accounting into our into the day-to-day acquisition policy of a startup. Typically, a startup that acquires at a cheaper price and are quicker to acquire, and then have a higher acquisition rate, their cost per account would typically be lower. Then the key thing for an organization to look at in the venture capital or the startup phase is its profitability, and profitability per account. And while in the Series A stage, most probably each the customers that have been onboarded are most of them would not be profitable. But what we're trying to look at here is that we're trying to look at two things. What would be the timeline when this customer that is being onboarded today would become profitable for the organization? So that's one element that we look at. The second element that we look at in this phase or in the revenue angle is how much would it be profitable. So both of these things would actually determine the fact that that when and then how and when would we be able to get our customers the cost that we've or the investment that we've made in acquisition of that client become profitable. One of the things that we need to be careful around evaluating these startups is the fact that the acquisition for a customer is faster. One of the problem with startups and digital organizations is that the customers tend to move and then to switch from one client to another. The cost of switching in this digital age is substantially lower. Since the cost is substantially lower, the probability that as soon as the client reaches a situation where he's profitable for the entity, the quantum of transactions would reduce, and the customer will move on from using your product to a new cheaper product, because there will be another competition coming in. We can look at that. So like if we had Kareem in the auto auto taxi space, if I may call that. And as we moved on and we looked at, now there is InDrive, which is supposedly more cheaper and more quicker, and more flexible in terms of pricing. And users find InDrive more cheaper to look at. As so based on that, we have seen there are customers switching from Kareem to InDrive, and therefore the amount of money that Kareem had spent on acquisition of that client and retaining that client in the early stage in terms of giving peak hour discounts or maybe giving discounts to the customers in one form or another. uh, uh, when the time came in to actually anchor the client and make money from it, the customer has now, because of a competitor coming in, switched on to that, and then it becomes difficult to look at and survive. Similarly, as UV and that was another situation where we can see how the burn rate actually ate up the financing that was available, and acquisition of fixed assets were substantially higher than the amount of seed capital available for an organization. So a lot of case studies that are being developed at this point in time, and in the startup stage, which we can look at and try and identify the errors that one makes in this field. But as this is a new area, we will see a lot of problems come in, a lot of entities survive, a lot of entities die out. But as new and new suppliers come in the digital space, in the startup space, in a specific area, it just keeps on proving the fact that things are more, that the idea, the concept is clear. Maybe the financing and the decision of laying down the investments was not that clear and well thought of, and therefore it highlights the fact that the two bodies and us as the financing and accounting people need to step up and play our part in ensuring that we act as a team of people who tend to break and who tend to bring we tend to bring a sanity to the acquisition and the marketing space, and the thought that the owners and the founders have in terms of their enthusiasm. Moving on from there, once the Series A financing has been there and the second stage financing have moved on, then comes a stage where the organization really needs to expand aggressively, and that is when the company looks at bridging its needs, which is typically what we call as putting in the investment money or the long-term investments that the organization will acquire. An aggressive expansion would come in, and the company would put in long-term assets here, and then these long-term assets would actually help bridge in the expansion with and continue to fuel the expansion that would come in. Then as the organization becomes bigger and more fatter and sustainable, there would be a lot of interest from investors who would actually be looking for a more stable or an organization that has spread its tentacles into the ground and is rooted. That's when mergers and acquisitions would come through. Big giants would want to acquire these concepts and build them into their own ecosystem. We have seen Google and Facebook do that to WhatsApp and Instas and other such small software and build them into their own ecosystem. That's when the acquisition would come through. In that stage, the founder would either go out and pass on and hand over the organization to the acquirer, or maybe continue to work for the acquirer and be part of that unit and that business unit. Similarly, what could also happen is that at some point in time the founder would want to this becomes too big for the founder to manage the organization himself, and in that situation the founder would want an exit route, and in that situation he or she would look at a strategic investor, or and alongside that look at maybe doing an IPO and finding people in the market who would buy his or her stock. And in some situation, the person or the promoter who the angel investor actually who'd helped the founder bring his thought process into reality. That individual would step up and buy the organization buy the organization and then pay the founder, and then run the organization onwards, being part of it. So that's how the venture capital we've seen grow, and it has become it has become a real interest element in this market. As we look at Pakistan and the world these days, Islamic financing has been one of the key elements and the developing area. While a lot of thought goes into Islamic financing and the fact that Islamic financing is typically nothing else but conventional product redesigned and covered in Islamic robe. I would tend to slightly disagree and humbly state that Islamic financing, while yes, these tend to fill the needs of the clients as of the current financial system, and typically therefore targets a specific need. But one of the key things that needs to be understood is that the underlying thought process or the niyat for that amal is actually to try and make it push it and try it make it a little more more palatable and understandable in the Islamic space. What I've tried to do, I've tried to link the Islamic words with the key financing methods that we've looked at earlier throughout our sessions. And so Murabaha as a product is lending for typically working capital purposes, and it's credit for trade business that one undertakes, typically for inventory, either for inventory management or for account receivable management. Ijara, lease financing. So it's Islamic form of Islamic structure to lease to lease and leasing as a product. Debt financing, when you try and structure it Islamically, the product is called sukuk, and it's mudarba. Hello, am I audible? I think I lost audio.
Yes, Prasim Saab, you got disconnected, but now your connection is back live on.
Okay, thank you. Uh, just repeating, salam and istisna are ways and means by which we can lock in our forwards and lock in our commitments to how things would be there in the future. Similarly, if I look at Musharka, so Islam 1400 years back laid down the rules for venture capital and supported venture capitalism and startup financing and then really looked at ways and means by which one can one can hold the hands of the founder of the business and then invest in the thought process in itself rather than the business which is already working and moving through. So for already established business, Islam has a format of murabaha, but for new businesses and in things that are being set up, there are venture capital and venture capitalism musharka products that we can look at. So that typically wraps up our financing modes. If there are any queries to this, please let me know, and then we can address them before we move into the behavioral finance area and look at how investment decisions are impacted by behavioral finance.
I would like to request all of would like to request with all of the participants to please type in your questions if you have any.
Okay. Moving on to the next phase. To a next phase of or a final leg of of our course or a webinar, and then we look at we look at how the world is developing and the new form of studies that are coming through. And then the key thing to look at these days is behavioral finance. Uh, Behavioral finance as a process tends to look at the fact that while we continue to say that human beings are rational beings, and they tend to follow a certain method to the madness, and there is always some logic behind an investor doing something, and then their value being generated. But there are times when that logic or there is no financial answers 2 plus 2 to an investment case, and then the field of study that tries to identify why people tend to take a certain decision and how that will impact is the field of behavioral finance. Looking at on why so why does behavioral finance tend to come in? Because the people who are not part of it and really want to benefit from the move as things are moving, and benefit from herding as a concept, uh, they would really want to understand when would certain things start and when would certain things stop. Because the key thing for an investor is you see, things tend to move from a certain place to a certain price, and when that trajectory is happening on an upward or a downward scale for that matter, uh, if we always try to find the bottom of the investment to get in, and when we try to exit at the peak, the problem is that we do, that's not the right place to do, because market tends to either overshoot or undershoot what one prices as a potential peak in pricing. So it's always good to know to know or identify where that most popular statement of U-turn is going to come, and just try and turn before everybody is about to turn. And as soon as you turn before them, you're when the herd is moving on the other direction, you're actually in that space and you're before them. So you tend to make more money on the other side also. And while you would have lost a small element of the peak, but you would but if you look at our if you look at the business, we would have actually made money on the on the other side. Uh, so 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 that's one. So that's an element to look at. Um, Herding. I did start with herd. Let's start with herding. Herding as a concept means that herd mentality. What does herd mentality mean? That the buyers and sellers tend to follow the market. Uh, we as human beings tend to delegate decision making, and while we're afraid to follow we're afraid to follow we're afraid to take decisions, and we tend to rely on other people. That's how humans have been made, and that's how actually animals have been made, that they've been made followers. Humans have an element of animal instinct in them, and we tend to get cozy when we are in a group. We are a social animal, if there is anything like that. So we like to stay together with people, and as we like to stay together with our set of people that we have. The key thing is that herding is a mentality where people tend to follow, and therefore it creates an inertia. And anything that's moving in one direction because of people jumping in will continue to move with a stronger force in that direction. And then people will jump out, and as people jump out, others will see it and then jump out also. And the inertia, or the thing moving, or the speed of the movement of an investment or a price of a security in a certain direction would tend to peak out. So that's hurting. How can we as an investor tend to apply? So the thought process is, we need to find out where the herd would be at its peak, and the largest size of the herd, and that is when we tend to that's the right place to start exiting our position, and then building the position in the opposite direction as the herd starts to thin out, and as it is thickening, that is when we tend to build our positions, and then peak it out at its at the herd's biggest size, and then as it starts to thin, we tend to exit our position. Another key thing to understand for an investor is that people love profits and hate loss, and therefore it's very difficult to cut your losses, and tend to stick out, and to tend to hold near and dear the decisions that they've done. they tend to marry their decisions, and then even if the investment is in a loss, they tend to stick around with it. Whereas on the other end, profit, people are very quick to exit positions that are in profit, and tend to be very happy and quick to lock in the profit. So therefore, we need to understand how the situation is right now, and based on how market prices have moved, we need to look at whether the customers that are there or the other investors that are there, are they in a loss mode or a profit mode? Because as soon as people start to make money, we would see a huge supply of that investment coming in the market, and then sellers would jump in. So the demand and supply dynamics would change, and while the intrinsic value may be substantially higher, we may see a slowdown in the middle because of the fact that there is profit taking, what the market calls that profit taking happening. One of the key things that we need to also understand is that that investors generally tend to be overconfident, and tend to stick around with the set of biases and the set of investments that they have already undertaken. So what would happen is that the investors would tend to continue to stay in the space, or the products that they really like. So somebody who's been there in 5 years or 10 years back would always love OGDCs and the PRLs, and Mari guesses of the world, because that's what were the key blue chips at that point in time. But if you look at an investor right now, in 5 or 10 years time, his favorite scripts would have been systems and TRG and the tech products at this point in time. So there would always be those investors who would tend to stay in their space, and would tend to love their favorite stocks, and would be overconfident about what the stock would be priced at, or what the investment would be priced at. Based on that overconfident, they would tend to stay and like that security, and then like that price, like that investment, and would tend to overprice those securities that they are comfortable with, and in their overconfidence. So therefore, the pricing of those securities would be substantially higher than the other ones. Information we've already talked about in our earlier space. In behavioral finance, the thought process for information is that it cascades in a waterfall format, and those at the top, or the pyramid of the information catchment, tends to get the information first, and tend to price it in, and as the information flows through to the greater public over time, the impact of, or the movement of that price is substantially smaller, and while the noise is louder in the waterfall as it hits the ground, but then the benefit of movement in terms of the height change, or the fall that is there, is not that high. And when we need to remember, as the waterfall falls and hits the ground, it's tend to bounce back. So therefore, if you look at information as a waterfall, if you read the pyramid of the information waterfall, you tend to get the biggest price move, and you get to benefit the highest. And as the information tends to be disseminated to the public at large across the mountain base, and tends to fall in the river, the price would bounce back. So what as behavioral as part of behavioral finance or as part of behavioral thought process we need to understand in our investment thought process is that the information that that we are pricing in or we are trying to put into our product is where does that stand in the information waterfall? How public the quantum of public domain that the information has fallen in. Just a cautious thought process. The price. The price. When I say public domain, an information that is already there in the newspaper, that is already there on a website, that is already there in public domain, is not private. But even as the information becomes public, some may be aware of it, some may not be aware of it because of their individual spaces and their idiosyncrasies that each individual has. Based on that, information may reach a certain individual at a later stage because he would not have read or he would not have accessed that public domain information available already there. So that does not mean that this is the private information and the arbitrage that they are making this is an arbitrage opportunity, but this is something that is there because of information being information reaching the individual late, or they may be able to get hold of or they may be slow in pricing it and conservative as we see in one of our next steps is that when things come to you, when information comes to you, when you see something happening, the investor may be conservative and may not be that quick in converting that information into action. And unless investor uh, converts that into action, any price that is or any information that is available to the investor does not benefit or yield returns to the individual. Um, Overconfidence is linked with mental accounting, where an investor may believe that mental accounting, he's more of an expert in mental accounting and may be able to do things. One thing that we need to be careful on that as finance graduates and become more and more complicated, the pricing of a product moves away from the basic 20-year back accounting methodologies that were there and now moves into formal accounting space and more complicated formulas to be used for pricing a security. Then narrow framing, behavioral finance. When you look at narrow framing in the behavioral finance context, it means that similar to jury window or similar to our own perspective, whatever we see, we tend to frame it. We tend to look at it in the context that we live with and we are born with. And based on that, we tend to see things as right and wrong, black and white. While in actual things would be gray and things would be different in a real form. So based on that, while the reality may be gray, but investors would either be looking at it as black or white, and in terms of pricing it accordingly and making decisions accordingly. With that, I tend to wrap up my area of financing and investment decisions. Any queries that are there, Feroz, we can look that up and address that before we hand over to Ali for his equity.
I think let the participants type in the question and we can start with Ali Nawaz. Hello,
Yes, I
Mr.
think
Ali.
that.
How are you?
Over to you, Firoz.
Thank you, Muslim Saab. I would like to welcome Mr. Ali Nawaz. Mr. Ali Nawaz is the CEO, if I'm not wrong, of Chase Securities. I got your introduction from Mr. Muslim Raza about your today's session. So, without losing any time and doing justice to your introduction, I'll hand over to Mr. Ali Nawaz, who can formally introduce himself to our members and participants. Over to you, Mr. Ali. You're not unmuted.
Sorry, can you hear me now?
Yes,
Yes.
over to you.
Bismillah ar-Rahman ar-Rahim. Assalamu alaikum. Thank you so much, Feroz Saab. Thank you so much, Muslim Saab, for the introduction. Feroz, if you can please allow me to share my presentation so I can just start with that.
Sure. Just let me give you the right.
Sure.
Here you go. You will be able to share your presentation now.
Is my
Okay.
screen visible?
Yes.
Right. Right. So just quickly starting with our topic, invest in stock market or not. This is the question which is being broadly asked in these times with respect to the economy situation which is currently happening, and then there are some political tensions, and then something with regards to geopolitical situation. So these are the questions which normally investor or any normal person could ask, as whether we should enter the stock market or not, or invest in stock market or not. So I'll try to just cover in my presentation is what is currently going on in the market, and if I will be able to answer should we invest in stock market or not, and how to invest in that, in the stock market. So starting with what is stock market, I think these is a very basic question which we all know, is that the shares are bought and sold, and the companies who want to raise capital do that through listing at the Pakistan Stock Exchange. But then we also know stock exchange with other names, as there are many ways to trade in the stock market. One is through a professional way in which one invests through complete research and analysis, and the other way to invest is you just invest on hearsay, or on the advice of your friends, your family, or even your stockbroker. So uh, there, there there has been chances of profits and loss in both in both techniques. But one fundamental question is we commonly get to hear from our friends, colleagues, or from random investors that they lose money in the stock market. And we know many people in our circle who would say that we had invested in the stock market and then we have lost a considerable amount of our savings or our investments. So I just want to show one chart which shows this is the KC 100 index performance for last 15 years. And in last few years, we have heard uh, that people have lost money in the stock exchange, but the chart says that the market started from 10,000 and currently it is trading around 41,000. So the market trend has been positive in last 15 years, and the stock market started at 10,000. Currently it is at 41,000. It touched the height of 52,000. So how would anyone who have been invested for a long term could have made losses? Yes, there were chances if you would have invested in the in wrong stock. But then if you are broadly invested in KC 100 index, or you have a diversified portfolio, so your portfolio should have done well, theoretically speaking. So then there must be some then how one does lose money in a stock exchange. So there could be one way of losing the money. For example, if the investor has bought the stock at around these levels and then sold at these levels, or bought back at these levels and then sold it, so the investor would have lost money due to trading or volatility. This in the broader run, this is the performance of this is actually this piece of chart, which says that this was only a short-term volatility. It is a chart of lucky cement. Yes, the stock has gone up, stock has come down, there has been volatility, but the trend of the stock, if anyone would have invested for a reasonable period of time, would have made money out of it. For example, for the last this is chart of last 5 years or 6 years, and the stock has rallied from have rallied 200-300%. So this was one area where investor would have tried to time the market or invested with a short-term view and would have lost money. So there has to be a professional investment process as to how would an investor or how would a layman investor would have identified as which stocks to invest. So there, I have just listed down a few 5-6 techniques or 5-6 process which should be followed before making any investments. And once that this process is followed, the chances to lose money reduces considerably. Number one, screening. Screening is, if you should actually there has been a quote from Warren Buffett as you should invest in stocks which you understand, which you know what the company is doing, you understand what is the business model. So first we have to screen the stock. There are around more than 500 stocks listed on Pakistan Stock Exchange. So for example, let's say banks, let's say autos. These are relatively simpler business model. You know, they produce car. You know what are their raw materials, what are their selling prices, what are their raw materials. So first you have to screen in which sectors do you understand well, and in which stock. Someone having an IT background might be able to understand IT stocks well. So you have to screen what are your core competencies, in which sector are you comfortable investing with. Once, for example, you identify a stock, the second thing which you should look at is the management profile. Is the company is managed by a professional management, or is it a family-owned business? Do they promote corporate culture? And once you have some faith that yes, the company is professionally managed and there are no visible corporate governance issues in the company, then you will have to do a basic research on the company. The research could have been what are the historical growth and what are the projected growth for revenues, price to earning, price to book, dividend yield, what are the profitability, what is the market say, or what is the outlook on the future prospects of this company and in this sector. For example, if you want to invest in an auto company, this might not be a very ideal time to invest, considering there are some import regulations with respect to import of CKDs. So there we might see some slowdown in the sales. So these are some basic research which one can do. And then there has to be a focus list. For example, you cannot keep a track of 100 stocks or 50 stocks, or let's say 30 stocks. You have to make a focus list, or you have to shortlist those stocks, after which a brief research you have you understand that you are comfortable with these sectors or these stocks. So there has to be a selected focus list on which you can track the developments of those stocks or sectors. And then there is a particular stock selection whether you have to invest now in these 4 stocks and keep the other 2 for on the watch list. And then there is an investment decision with regards to how much investment do you have to do you want to make in any sector. Firstly, asset allocation, you have to invest 80% in fixed income and then 20% into stocks, and then out of that 20%, how much do you want to invest in each sector and then each stock. So you should diversify your portfolio so that the risk is managed. Then what is the equity market outlook for the foreseeable future? You would see that the stock market was in 2008 global financial. Okay, firstly, what is market cap? Market capitalization is the value of shares traded in the stock exchange. So and GDP, I think you are familiar with. So there has been an indicator of what is market cap to GDP ratio. So market cap to GDP ratio was 44% in 2005, 2006. Then it was 30% in 2016, 2017, and now it is well below its mean. It's now at around these are year-end numbers. It was 14%, and currently it is in the range of 11% to 12%. So this indicates that market is currently currently trading at very attractive valuation, be it due to political tensions, be it due to the economy situation. But this is one indicator, which tells us that the market is currently at a cheap valuation. The second is KC 100 forward PE, price to earning ratio. The long-term mean is 8 times price to earning. 3-year mean is 6.5 times. Stock market is currently, as on December 21st, it was 4.9 times. Currently, it is trading around 4 times. It is currently near its low, which was in 2008, the global financial crisis. There's no such thing right now. Global financial crisis was much severe, but then due to some political problems and the economy, the market is back to its multi-year low. This is the second indicator which tells us the market is very cheap at these levels. And then you would see these are the historic returns from 2000 to 2021, and we've seen that in last 21 years, market has posted negative returns in only 5 years. And after that 5 years, after each year the market has closed negative, the following few years were very positive. We have seen this in 2001, we have seen this in 2008, we have seen this in 2012, and we have seen this in 2017-18. So out of last 21 years, there was only 5 years where market performance was negative. Then these are some historical numbers of equity market performance. You would see that KC 100 index return CAGR average for last 21 years was 15%. Real index, which is not very widely followed index, but then there have been some numbers from Zameen.com, so which tells us that the real estate index was 12% up, gold was 5% on average up, oil was 5%, T-bill was 8.7%. So equity has remained historically the best asset class to invest, provided one has invested in the right sector, right stock, and have not lost or invested money in speculative stocks. So thank you so much. This was a brief presentation. If you have any questions regarding this presentation, please feel free to ask. Thank you.
Thank you, Mr. Ali Nawaz. We are looking at the questions and just waiting for some participants to type in their questions.
Sure.
In the meantime, can I request you to give a formal introduction? We didn't receive a formal introduction.
Right, sorry. So my name is Ali Nawaz. I am CEO of Chase Securities. I founded this Chase Securities in January 2022. I was head of capital markets at Samba Bank for last 8 years. I was heading their capital markets business. And before that, I was with Silk Bank heading their capital markets business. And before that, I have worked 3 years for Alpha GHP Investment Management in their portfolio management department. So I have an experience of last 13, 14 years managing equity portfolios for banks and mutual funds.
Thank you, Mr. Ali. Quite an extensive experience, I must say.
Thank you. Thank you.
I would like to request all the participants, if you guys have any questions relevant to Mr. Ali Nawaz, Mr. Muslim Raza, please type in your questions.
Ali, if it's okay, can I ask a question to you?
Sure, absolutely, please.
As
It'll be a
somebody
tough one.
who so as somebody who is not into day-to-day monitoring the business and monitoring the equity market, and then somebody who sits outside and has his hands full with his own work, what advice would you give to a passive investor like me? Which areas to look at, which stocks to look at, how to make quick money?
Right. So basically, there are two ways to do it. One is a passive active strategy, and one is a passive strategy. What is a passive active strategy? For example, when one wants to invest in stock market, and then he might not have that much time to do research themselves. So then they can open an account with a brokerage house which has their own research. So once you open an account, you can subscribe to their research services, and then you will get a frequent research on your email, on your WhatsApp, and they usually share their top picks and their outlook on the market. So you can remain updated on what's happening in the market and what's the outlook for the future. And secondly, there is a professional traders calling you and advising you on how to manage your portfolio, and then you can discuss with that professional and then you can devise your portfolio. The second way of doing it is through a mutual fund. You can invest in any stock fund, a certain percentage of your investment which you want to invest in stock. You can invest in any mutual fund, and then the professional management in the mutual fund, who are doing their own research, who are managing billions of portfolio, they do investment on your behalf, and that is one passive way of investing in the stock market.
Thank you, Ali.
Thank you so much.
Okay, Ali, there is a question on REITs. So,
Okay.
would you be able to help us and talk about REITs and how REITs as a product and how they are structured?
Yes, sure. Real estate investment trusts are like a mutual fund which invests in real estate. Actually, there is a pool of funds, and by using that pool of funds, the real estate investment manager or the investment manager invests in a real estate project, and then the returns out of that real estate, whether it be a rental income, whether it be a capital gain income on sale of that real estate, is being shared by the pool of investors. Currently, we have only one real estate company listed at Pakistan Stock Exchange named Dolmen City REIT. The Dolmen Mall is under that REIT structure, and they usually pay out dividends from the rental income earned from that real estate. And there are a few more real estates which are in pipeline, which will be launched next year, inshallah, and you will see 3-4 real estate investment trust trading in stock exchange. And one can invest in those real REITs similar to that one invest in stocks. You need to have to open an account with any broker, and then you can ask them to invest in the REIT of your choice.
And then, if I may ask, how does REITs compare to property as investment as an asset class?
Right. So one benefit of real estate is one benefit of REIT is actually for buying a real estate, you must have a decent amount of capital or an investment. But the benefit you get out of REIT is you can invest with a small investment amount, be it you can invest on monthly basis, you can invest on quarterly basis as the funds are available with you. So this is one way of getting an exposure to the real estate market if you do not have a reasonable amount of capital to invest directly into a plot or a building or any real estate. So the exposure can be taken through these REITs.
Okay. If I'm correct, Ali, do add to this. There are rental only leads, and there are REITs that give benefit for both rent and physical price movement.
Yes, absolutely.
So what is Dolmen REIT? Is it a rental REIT, or is it both?
It is both. The income is from rental yields, and then the income is from revaluation of the property and also.
Okay. If I may, since you mentioned mutual fund, what always intrigued me and got me confused are the various asset classes and the names that the funky names that the mutual fund industry uses. So like asset allocation and income funds and fixed income product, government securities, mutual fund. So I know that's a pop question, but maybe if you can help us run through that.
Sure. So basically, there are broadly three types of funds. Number one, which is you may classify it as a fixed income fund, which consists on fixed income instruments, T-bill, PIBs, Sukuks. The second is equity fund. The third is asset allocation fund. Asset allocation is a mix of both. For example, one does not want to invest 100% equities or 100% in fixed income. The third class is a balance. Some may call it a balanced fund. Some may call it an asset allocation fund. So there is a mix of both. And then there are further subclasses of these type of funds. For example, fixed income funds you may see funds with the name of income fund. You may see funds with the name of cash fund, money market funds. So basically, there has been a minor differences in terms of the portfolio holdings. For example, if a fund is an income fund, it can invest in instruments from, let's say, 1 week to maybe a 10-year bond. But if it is a cash fund or a money market fund, it usually invests in short-term instruments. But then there are balanced fund on asset allocation funds. These funds basically invests in a mix of fixed income and equity funds, and it is on discretion of the fund managers. If the outlook on equity market is good, he would increase the exposure of equity and reduce the exposure of fixed income. And if the market is volatile, or is the market the outlook on market is negative, he would reduce the exposure in equity and then increase the exposure in fixed income. And one is equity fund. Then there are further subclasses of equity funds, such as there are let's say sector funds, financial sector fund or energy sector funds, which invest in specific sectors. So you may see different funds trading with different fancy names, but if you would read the description written on the offering document or the fund manager report, or you would just see their portfolio. All mutual funds publish fund manager reports monthly. It's publicly available on their website. So if anyone wants to invest in any fund, he or she would just want to see the fund manager report and in what instrument that does that funds invest, and what are the historical returns. It is a one-page report of every fund. You will get all required details on that one-page report. So these are the three broad categories, and there are one should not be confused from the fancy names, but the core investments would be in any of these three investment strategies.
Thank you, Ali. Thank you so much for all the information that you have shared with us. We have some questions from the participants. Sure. Okay. One of the participants is asking what are the pros and cons of investing in mutual funds, and how would you advise on building a diversified portfolio?
Correct. So pros and cons of investing through a mutual fund, I would assume it is in equity fund, or let's say any kind of fund. The advantage of investing through the fund is you do not have to invest through you do not want to have the research done by yourself. There is a professional management who is doing the research and taking the investment decision on your behalf. The con of it is, or the cost of it is, they are charging a management fee for it, and they do charge a nominal fee for that is their professional fee for managing your fund. The second positive of investing through a mutual fund is you will get a very diversified portfolio, in the sense that each mutual fund holds stocks in the range of 10 stocks to, let's say, 50 stocks. They well diversify portfolio to cover risk. The disadvantage of that is if you want high returns, and if you want a focused portfolio, that might not be possible through that structure. And secondly, well, the second part of the question was making a diversified portfolio. So one can do that. You have heard the name of blue chip stock. There's one website called dps.psx.com.pk. It shares all the data of the stocks that are being traded at the stock exchange, what are their volumes, what are their price performance. So you may get to see what are the blue chip stocks. For example, ideally, if building a diversified portfolio, you might want to have between 5 to 10 stocks in your portfolio, and ideally 1 or 2 stocks from each sector, and the outlook on those sectors should be positive. For example, in the higher interest rate scenario, banks are doing well. You might want to have a banking stock in your portfolio. Due to high oil prices, E&P stocks are trading at very good valuations. They have posted a good earnings. You might want to have an E&P stock in your portfolio. Then there are fertilizer sector. Fertilizer. We are an agricultural country. The fertilizer demand is stable. One fertilizer sector. Then we are textile exporting country. Then we have we do export IT. There are IT stocks traded. So you may have a diversified portfolio, one or two stocks from each sector. So and once those sectors or those tech stocks start performing, your portfolio return goes up. And God forbid, if any one or two sector doesn't perform, the losses are compensated from the other three stocks or sectors which have performed well.
I'd like to, with your permission, Ali, I'd like to add.
Yes, please.
So the first thing I think that an individual needs to look at is understanding his or her exposure and his or her ability to undertake risk and the evaluation. As a question that I put onto you in the start for a passive investor. So if somebody is a passive investor, one of the key things or a focus area to look at is maybe move on to and try some mutual funds, and then maybe look at a passive an asset allocation or a full equity risk mutual fund. The key evaluation that the individual would be doing when investing in a mutual fund is actually taking a call on the investment team of that mutual fund, and I think that would be an easier bet to take than evaluating individual stocks. So that's my thought.
Absolutely.
Thank you. Couple of more questions. Hamad Rehan wants to know what is the best method to buy shares in an IPO.
Right. What is the best method to buy shares in an IPO? Unfortunately, this year there has not been an IPO due to the market conditions, but then there were IPOs in 2020 and 2021. The best way to do it is now the stock exchange has launched, stock exchange CDC has launched an e-IPO portal. One can digitally subscribe to an IPO. There's one website called eipo.psx.com.pk. So when any IPO is announced, one can log in to that portal, insert their bank account details, and then subscribe to IPO. The second way of doing it is through a bank. There is normally 7-8 banks which is announced by the company through which the IPO can be subscribed. The forms are available in those banks, and one can fill out that form, pay through a pay order or a check, and then can subscribe to an IPO. The third way of doing it is you can call any broker, and then the broker can also facilitate the whole process on your behalf.
Thank you, Ali. Basic question from Mohammed Farouk.
Yes.
Do REITs have to declare the investor's profile with external stakeholders, or it can be kept as normally in NGOs?
Sorry, can you please repeat the question?
Yes, sure. The REITs that we were discussing, real estate investment trusts.
Yes.
Does such trusts have to declare the investors' profiles with external stakeholders, or it can be kept as normally it's done in NGOs? More of a compliance-related question.
Right. So basically, real estate investment trust is comprises of a pool of investor. There is a launching asset management company you know the background as who are the sponsors of that real estate investment trust, or which company is launching it. But then the pool of investors, you do not get to know the names of the investors who have participated on in those funds.
Thank you. Last question. In real estate investment, rentals are ranging from 3% to 4% of investment, where our banks are offering 13% to 16% in return. Appreciation of real estate is only something that is compensating. Any comments how to make smart decision while saying yes or no to rental, real estate investments?
Right. So the investment through REITs would work the same way, uh, like if you would buy a real estate yourself. The only advantage you get through REIT is you can invest in small amounts. Yes, there are incomes through real estate, rental yields, which can range between 3% to, let's say, 8%. But your returns will be your return will comprise a mix of both the appreciation of real estate price and the rental yields you would get from it. So it is not a short-term investment. You will have to make a view of let's say, if you buy a real estate, you have to make a view of 2, 3, 4, 5 years, and then you would see that the value of real estate will increase over time, and then the rental yields will also be accumulated in these funds and distributed through dividends to the investors. So basically, when you are investing in REIT, you will get to know in which real estate are they investing, and then you would have a view on that real estate as whether the price of this asset will increase over time, which definitely will. I think the real estate in Pakistan has been rising on a uh, constant method or constant scale. So basically, your investment in REIT, you would need to have a view on that property. And once you have a view on property that there will be a consistent normal rental income and capital appreciation, then you can invest in that real estate, or you can choose to invest in any other real estate funds. You will see a variety of funds that will be offered in 2023.
Thank you so much, Mr. Ali. I think that's it for the questions. Anything that you would like to add by yourself?
Hey, thank you for giving me this opportunity. It is a very great panel, very great audience. I think uh, the audience or the students of ECCA or the ACC team should capital markets is very integral part of any country. Once the capital market flourishes, the different companies or the different entrepreneurs come to capital markets to raise capital, and then there is a broader economic activity which gets triggered through the capital markets. So I would request all the students of ACCA to at least follow the capital markets, what's happening, what's the current developments, and then hopefully our capital markets can be as active and as good as of any developed country. Thank you so much for inviting me to this session. Thank you so much.
Thank you. You're welcome, Mr. Ali. Anything that you would like to add, Mr. Muslim?
I would like to, as a closing remark, I would like to thank the ACCA team, and the certainly the audience was wonderful, and the questions were very pert and very sharp. Similarly, I would request the ACCA team to undertake more of such series, and I think this was very beneficial for me as a presenter, and the other sessions that I have attended were also very thoughtful. So thank you guys, thank you for giving me that opportunity, and looking forward to more of it. Thank you.
Thank you, Mr. Muslim. Thank you, Mr. Ali, for your time and the knowledge that you have shared with us, with our members of HCCA. And I think that's it for that's it for the topic of the discussion. And we will be joining back on Wednesday with our next topic and with a new trainer. Thank you, both of you, for your time. And the sessions were really interesting, and the knowledge shared was priceless. Thank you, everyone, and have a good week ahead.
Thank you so much. Thank you.
Thank you, Khudafis.